floor show on this Wednesday. Goldman Sachs asset management client investment strategist Elizabeth Burton is here. Market sentiment right now. Of course, we're seeing a slowdown today, but overall, we've been very close to records. What are you seeing?
Well, it's interesting. We just wrapped up our Global Alternatives Investment Summit at Goldman Sachs, where we hosted 450 of our clients and partners across LPs and GPs. And I would say there wasn't fear that we might be seeing today in the red. We're seeing cautious optimism. And interestingly, a couple of my takeaways from the conference, no one was really asking about inflation. And the concerns are kind of different between if you're talking about U.S. investors and ex-U.S. investors. Ex-U.S. investors seem to be more concerned about geopolitics. The U.S. investors, as you can imagine, are thinking, is this U.S. exceptionalism trade overblown? Which we think the fears around that are overblown. We're still mildly pro-risk, and it seems that our investors are feeling the same way.
When you say mildly pro-risk,
right,
what fits into that description?
Well, the first thing that would come to mind would be that we're still overweight equities. In fact, if you look at our asset allocation on a 3-month and a 12-month basis, we're still overweight equities, although neutral across geographies. But we're still constructive on the U.S. And our advice would be do not pull back from the U.S. Stay invested there, but start thinking about hedges and diversifiers around that trade.
Don't pull back from the U.S. Well, a lot of people appear to have very concentrated portfolios in U.S. and then technology within that area. Is that something where you're advising clients to spread out and move beyond that?
It's a great point. We actually just put out a report on this on our website, and they're not just concentrated in equities and technology and AI and a bunch of these themes. It used to be they were concentrated in healthcare and tech. It's across their whole portfolio, right? It's in their private markets portfolio, it's in their credit portfolio, it's in their equity portfolio. So we are saying diversify your exposures and look other places. Look in, we're seeing clients interested in private credit in Europe and in private equity in Asia. And we're seeing clients on the public equity side interested in India and still considering trades in Japan. So there's a lot of pockets of opportunity that we are encouraging folks to look, but we're, maybe diversify out, but don't get negative on the U.S.
Don't get negative on the U.S. Well, what about this? And I know it's probably not a focus for your clients, but we're seeing the retail investor come jumping in once again with names like Beyond Meat and Krispy Kreme. Both have jumped very dramatically over the past week and the past month. So when you look at this kind of behavior, I don't know, it's interesting that when you start to see that the ETF called Meme come back online. Right. It's not doing so well, but again, this means that people are engaged in the market. Are they late if they're coming in right now?
It's an interesting question because timing is really everything, right? And if you look at equity market returns from GFC through current, if you had missed the top 50 trading days, your returns would be closer to bonds than to really equity returns. So the timing of when you enter the markets does matter. On sort of speculative trading in markets, one thing I'd actually point to is gold, which is really popular right now for a number of reasons, has a number of tailwinds. But as speculators get into that market, you should expect more volatility. So we've been hearing questions actually around silver. Well, that's an even smaller market. And as you get speculators there, investors should be cautious. Well, we're still constructive on gold, and we think an allocation there makes some sense. But you have to be careful in what are you using that allocation for.
And the sell-off in gold continues today, past 3 days, I believe, that it has really gotten hit. I believe the biggest drop yesterday since
10 years.
13. Since 2023. I mean, I'm sorry, 2013.
Yes.
I mean, it's really, really nutty. I mean, that's a buying opportunity if you believe up until 3 days ago that gold has to be in a corner of the portfolio. Yeah,
it's interesting. We got a note from the Goldman Sachs desk this week that said that when the price rises in gold above $50 in a day, they get no calls on the desk. But something like this obviously spurs some attention. Right. I think I'd point folks back to the fact that there's still a structural story behind gold, that we still see central bank demand. And in fact, in our target for year end 2026 is still 4,900 with risk to the upside. And we don't factor in our base case, we don't factor in the speculators there or the ETF speculators.
Yeah, right now we do have gold at the moment standing at 4103 per ounce. 1 week from today, Federal Reserve meeting, announcement on interest rates. What is Goldman expecting? And do you find it interesting that the 10-year yield is below 4% again, and you said people aren't really talking about inflation.
Yeah, we expect a cut. We've been calling for 3 cuts at the back half of this year. We just had one. We expect sequential cuts, and then we expect 2 more next year, although the risk around those is, a little bit of a wider margin based on what happens. I think they will cut. We believe they will. And I think we are getting some data, right? Like earnings season is a form of data. There are alternative data sets that we can sort of point to. So that's our expectation. On the 10-year, yes, I was having a conversation about this today. What's happening in bonds is quite strange right now. On the inflation front, we're expecting CPI coming in at 3.1.
That's Friday.
Sort of not
Finally.
changing year over year, right? But I think investors are our investors are trying to look and see what they can manage and they can expect. And what they're really focused on is that terminal rate. Like, when are we going to get there and what is it going to be?
Elizabeth, I think we've all been focused on the terminal rate, and who the hell knows?
Yeah.
Good to see you.